Accounting for non-current assets. Introduction. In the balance sheet, non-current assets are usually recorded under the fixed assets section. They include the property, plant and equipment, intangible assets, and investment. To be able to prepare final accounts that show true and fair view, the acquisition, depreciation, and disposal of the fixed asset must be recorded appropriately. This is the focus on this lecture. Objective. At the end of this lecture, you should be able to prepare the necessary account for recording acquisition, depreciation, and disposal of fixed assets. Pretext. The cost of a machine with expected life of 4 years is 10,000 naira. If the residual value is 4,000, calculate the annual depreciation charge, accumulated depreciation, and net book value for each of the 4 years using 1. Straight line method, 2. Reducing balance method, 3. Sum of the years digit method. Content. A. Property, plant and equipment. This is generally referred to as fixed asset. They are tangible resources of an enterprise which are employed in its operation. In many enterprises, these assets are grouped into various categories such as land and buildings, plant and machinery, equipment, furniture, fixtures and fittings, vehicles, etc. The characteristics of the assets grouped in property, plant and equipment include the following. They are acquired for use in operation. That is, they are not bought for resale, not just idle facilities, and not still under construction. They are long-term in nature and usually subject to depreciation with the exception of land. They are physical substance, that is, they are not intangible assets. The accounting for property, plant and equipment consists of the entries to record the following: the initial acquisition cost, any additional expenditure incurred after the asset is replaced in service, depreciation or depletion, the disposal of assets. B. Acquisition cost of property, plant and equipment. The acquisition cost, also known as historical cost, includes the purchase price, net of any discounts, freight if bought FOB shipping point, insurance during shipment, testing and installation charges, other necessary costs incurred in getting the asset ready for its intended use. The actual cost element will depend on the type of assets as shown in the table below. Type of assets. Other costs. Land. Net purchase price, surveying cost, transfer of title, legal fees, cost of tearing down old buildings, cost of draining and filling. Land improvement. Cost of driveways, cost of sidewalks, cost of shrubbery, cost of parking lots. Buildings, construction cost, architectural fees, insurance during construction, fees of building permit, cost of surveying and grading. Natural resources, cost of acquiring land with the resources, mineral deposit, oil well, timber, cost of access road, cost of sinking mine shafts, cost of laying rail tracks. Leased assets, all capital costs indicated in the leasing agreement, equipment and machinery. Net purchase price, freight installation cost, insurance during shipment, testing. C. Capital expenditure and revenue expenditure. All costs incurred in relation to property, plant and equipment can be categorized as either capital expenditure or revenue expenditure. Capital expenditure is expenditure which results in the acquisition of non-current assets, e.g., purchase of machinery and equipment, which provides economic benefit over several periods, which causes a significant improvement in the value of a non-current asset extension of building. Capital expenditures are recorded as part of the asset. They include all initial acquisition costs that were necessary to get the asset ready for its intended use. It also includes any cost incurred after the asset is put in service which add significantly to the useful life of the asset or which represent a major addition. Revenue expenditure is expenditure which you incur for the purpose of the trade of the business salaries and wages, which provides benefit only during the current accounting period, which you incur to maintain the existing earning capacity of non-current assets, repairs of fixed assets. Revenue expenditures are recorded in expense accounts. They include costs incurred in order to just maintain the value of the assets. Examples include regular maintenance, cleaning, and minor repairs. D. Capital and revenue income. Capital income include proceeds from the sales of non-trading assets, e.g., sales of old equipment, proceeds from the sales of investments held by the business, introduction of more capital by the proprietor. Revenue income include income from sales of trading goods or provision of services, return on investment held by the business, e.g., dividend received. E. Intangible assets. Intangible assets are long-term assets that lack physical substance and are not held for investment. The most common intangible assets are as follows. Patents. These are exclusive rights granted by government to manufacture, use, or sell a certain product for a specified number of years. The legal printing and other necessary costs associated with obtaining and defending the patent is recorded as an asset. Patents are then amortized over the legal useful life. Research and development costs, R&D. These are expenditure made internally to support experimentation that will hopefully lead to new sources of revenue in future. Copyrights. These are rights granted by the government for the exclusive use of literary and artistic work for the time remaining of the creator's life plus additional number of years after his death. The cost incurred is recorded as an asset and amortized over the copyright's useful life. Goodwill. This is the extra worth price in over and above the market value of the net assets because of the future potential of the enterprise. Goodwill is recognized only when a company is bought and is recorded as an asset and amortized over its useful life. Franchises. These are rights to sell specific products or services in a certain geographical location. All necessary costs incurred in obtaining the franchise are recorded as an asset and amortized over the useful life of the franchise. Trademarks. These are exclusive rights to use a certain name or symbol for an unlimited future period. All the necessary acquisition costs are recorded as an asset and then amortized. Organization costs. These are expenditures incurred in establishing a business. They are also recorded as assets and then amortized. F. Investment. Investment are assets acquired not for use in the operations of an enterprise, accretion of wealth, through capital gains or incomes earned in the form of interest or dividend. They include fixed income investment, variable income investment, short-term investment, long-term investment, quoted investment, unquoted investment, government securities, etc. G. Depreciation. Depreciation is a systematic way of spreading the cost of a non-current asset over its useful life. It is the allocation of an asset over its estimated useful life, where depreciation amount is equal to historical cost minus scrap / residual value. The factors that you will consider in estimating the useful life of a depreciable asset include expected physical wear and tear, e.g. due to rust and decay, obsolescence due to technological advancement, expected rate of depletion for wasting assets, e.g. crude oil deposits, legal limits on the use of the asset, e.g. leasehold, patents, and copyright. H. Methods of calculating depreciation. There are numerous methods that you can use in calculating depreciation. The rule is that any method selected must be applied consistently. Some methods of calculating depreciation are explained below. 1. Straight line method. This is also called fixed installment method or equal installment method. Under this method, you charge equal amount as every year till the end of its useful life. You will calculate the annual depreciation as annual depreciation is equal to cost minus scrap value / useful life in years. 2. Diminishing balance method. This is also referred to as reducing balance method. To use this method, you will apply a fixed depreciation rate on the diminishing net book value of the asset each year. You will calculate the depreciation rate as depreciation rate is equal to 1/nth root of scrap value of cost times 100, where n is equal to number of useful life. 3. Sum of the year digit method. This method produces a diminishing depreciation charges over years. To use this method, you place serial number of years in reverse order as digits to each year. You will multiply the depreciable value of the asset cost minus scrap value into bracket by the ratio of the allocated digit to the sum of the digits. For an asset with 4 useful years, for example, you will allocate 4, 3, 2, and 1 as the digit for the first, second, third, and fourth year respectively. 4. Machine hour method. To use this method, you will calculate depreciation based on the total hour of assets used in a year. You will calculate the annual depreciation as annual depreciation is equal to depreciation per hour / total hours of use in a year, where depreciation per hour is equal to cost minus scrap value over estimated total useful hours. 5. Revaluation method. To use this method, you will revalue the assets at the end of each year and compare the revaluation figure with the value at the beginning of the year. This method is suitable for loose tools like hammer and spanners. You can obtain the annual depreciation under this method as follows. Depreciation is equal to closing value minus bracket opening value plus cost of new assets bracket closed. Example 2.1. On 1st January 2007, Capel Nigeria Limited acquired a cutting machine at a cost of 100,000 naira. The machine was expected to have a useful life of 4 years with the residual value of 20,000 naira. you are required to calculate the annual depreciation charge, accumulated depreciation, and net book value each of the 4 years using 4. Straight line method, 5. Reducing balance method, 6. Sum of the years digit method. Solution 2.1. Straight line method. In this question, cost is equal to 100,000 naira. SP value is equal to residual value is equal to 20,000 naira. Useful life is equal to 4. Annual depreciation is equal to 100,000 minus 20,000 over 4 is equal to 20,000 naira. Year ended 2007. Annual depreciation charge 20,000. Accumulated depreciation 20,000. Net book value 80,000. 31/12/2008. Annual depreciation charge 20,000. Accumulated depreciation 40,000. Net book value 60,000. 31/12/2009. Annual depreciation charge 20,000. Accumulated depreciation 60,000. Net book value 40,000. 31/12/2010. Annual depreciation charge 20,000. Accumulated depreciation 80,000. Net book value 20,000. Note that the net book value at the end of the useful life is the same as the scrap value. 2. Reducing balance method. Depreciation rate is equal to parenthesis open 1/4 root of bracket open 20,000 over 100,000 bracket closed parenthesis closed times 100% is equal to parenthesis open 1/4 root of bracket open 0.2 bracket close parenthesis closed times 100% is equal to parenthesis open 1 minus 0.6687 parenthesis closed times 100% is equal to 0.3313 times 100% is equal to 33.13%. 31/12/2007. Annual depreciation charge 20,000 naira. Accumulated depreciation 20,000 naira. Net book value 80,000 naira. 31/12/2008. Annual depreciation charge 20,000 naira. Accumulated depreciation 40,000 naira. Net book value 60,000 naira. 31/12/2009. Annual depreciation charge 20,000 naira. Accumulated depreciation 60,000 naira. Net book value 40,000 naira. 31/12/2010. Annual depreciation charge 20,000 naira. Accumulated depreciation 80,000 naira. Net book value 20,000 naira. Note that the net book value at the end of the useful life is the same as the scrap value. 2. Reducing balance method. Depreciation rate is equal to parenthesis open 1/4 root of bracket open 20,000 over 100,000 bracket closed parenthesis closed times 100% is equal to parenthesis opened 1/4 root of bracket open 0.2 bracket closed parenthesis closed times 100% is equal to parenthesis open, 1 minus 0.6687 parenthesis closed times 100% is equal to 0.3313 times 100% is equal to 33.13%. Year ended 31st/12/2007. Annual depreciation charge 33.13% of 100,000 is equal to 33,000 naira 130. Accumulated depreciation 33,000 naira 130. Net book value 66,000 naira 870. 33.13% of 66,870 is equal to 22,000 naira 150. Accumulated depreciation 55,000 naira 280. Net book value 44,000 naira 720. Take 2. 33.13% of 44,720 is equal to 14,810 naira. Accumulated depreciation is equal to 70,090 naira. Net book value is equal to 29,910. Annual depreciation charge 33.13% of 29,910 is equal to 9,910 at 31st/12/2010. Accumulated depreciation 80,000 naira. Net book value 20,000 naira. The calculation is approximated to the nearest 10. 3. Sum of the year digit. Depreciable value is equal to 100,000 naira minus 20,000 naira is equal to 80,000 naira. Year ended 31st/12/2007. Digit assigned 4. Annual depreciation charge 4/10 times 80,000 is equal to 32,000 naira. Accumulated depreciation 32,000 naira. Net book value 68,000 naira. Year ended 31st/12/2008. Digits assigned. Annual depreciation charge 3/10 times 80,000 is equal to 24,000 naira. Accumulated depreciation 56,000 naira. Net book value 44,000 naira. Year ended 31st/12/2009. Digits assigned 2. Annual depreciation charge 2/10 times 80,000 is equal to 16,000 naira. Accumulated depreciation 72,000 naira. Net 28,000 naira. Year ended 31st/12/2010. Digits assigned 1. Annual depreciation charge 1/10 times 80,000 is equal to 8,000 naira. Accumulated depreciation 80,000 naira. Net book value 20,000 naira. Total digit is equal to 10. 1. Methods of accounting for depreciation. There are two methods of accounting for depreciation. The first method, the old method, is where you maintain the asset account at the net book value. For the second method, the modern method, the asset account is maintained at cost. Asset account at net. To record the purchase of the asset, you will debit the asset account and credit the bank account with the cost of the asset. To provide the depreciation, you will debit depreciation account and credit the asset account with the estimated annual depreciation. You will then charge the depreciation to profit loss account by debiting the profit loss account and crediting the depreciation account. Asset account at cost. To record the purchase of the asset, you will also debit the asset account and credit the bank account with the cost of the asset. To provide for depreciation, you will debit the profit loss account and credit the provision for depreciation account with the estimated annual depreciation. Example: on 1st January 2007, Capel Nigeria Limited acquired a cutting machine at a cost of 100,000. The machine was expected to have a useful life of 4 years with a residual value of 50,000. The company uses reducing balance method of depreciation. You are required to prepare the necessary accounts for recording the above transactions up to 31st December 2009. Assuming 1. The asset account is maintained at net book value. 2. The asset account is maintained at cost. Solution: 1. When the asset account is maintained at net book value, from the solution to the previous example, the calculation of depreciation is as follows. Year ended. Annual depreciation charge. Accumulated depreciation. Net book value. Year ended 31st/12/2007. Annual depreciation charge 33.13% of 100,000 is equal to 33,130. Year ended 31st/12/2007. Annual depreciation charge 33.13% of 100,000 is equal to 33,130. Accumulated depreciation 33,130. Net book value 66,870. Annual depreciation charge 33.13% of 66,870 is equal to 22,150. Accumulated depreciation 55,280. Net book value 44,720. Annual depreciation charge in 31st/12/2009. Accumulated depreciation 70,090 naira. Net book value 29,910 naira. Cutting machines account. 1/1/2007. Bank through cash account 100,000. 1/1/2008. balance B/D 66,870. 1/1/2009 balance B/D 44,710. 1/1/2010 balance BD 29,910. 31/12/2007 depreciation A/C 33,130 naira. 31/12/2007 balance C/D 66,870. 100,000 as total. 31/12/2008 depreciation A/C 22,150. 31/12/2008 balance C/D 44,720. Total 66,870. 31/12/2009 depreciation account 14,810. 31/12/2000 balance C/D 29,910. Total 44,710. Depreciation account 31/12/2007 cutting machines account 33,130. 31/12/2008 cutting machines account 22,150. 31/12/2009 cutting machines account 14,810. 31/12/2007 profit and loss account 33,130. 31/12/2008 profit and loss account 22,150. 31/12/2009 profit and loss account 14,810. 3. When the asset account is maintained at cost cutting machines account. 1/2007 bank/cash account 100,000. 1/1/2008 balance B/D 100,000. 1/1/2009 balance 1/1/2010 balance B/D 100,000. 31/12/2009 balance C/D 100,000. Provision for depreciation account 31/12/2007 balance C/D 33,130. 31/12/2009 balance C/D 70,090. 31/12/2007 profit and loss account 33,130. 1/1/2008 balance B/D 33,130. 31/12/2008 profit and loss account 22,150. Total 55,280. 1/1/2009 balance BD 55,280. 31/12/2009 profit and loss account 14,810. Total 70,090 naira. J. Disposal of fixed assets. The accounting for the disposal of fixed assets will depend on whether you maintain the asset account at net book value or at cost. asset account at net book value. To transfer the net book value of the disposed asset out of the asset account, you will debit asset disposal account and credit the fixed asset account with the net book value of the disposed assets. To record the proceeds of disposal, you will debit bank/cash account and credit asset disposal account with the proceeds on disposal. To recognize the profit or loss on disposal, you will close the balance in the asset disposal account to the appropriate side of the profit/loss account. Asset account at cost. To transfer the cost of the disposed assets out of the assets account, you will debit asset disposal account and credit the asset account. To transfer the accumulated depreciation on asset to disposal account, you will debit the provision for depreciation account and credit asset disposal account. To record the proceeds of disposal, you will debit bank/cash account and credit asset disposal account with the proceeds on disposal. To recognize the profit or loss on disposal, you will close the balance in the asset disposal account to the appropriate side of the profit/loss account. Example: on 1st January 2007, Capel Nigeria Limited acquired a cutting machine at a cost of 100,000. The machine was expected to have a useful life of 4 years with a residual value of 20,000. The company uses diminishing balance method of depreciation. The management sold the machine for 62,000 on 1st January 2009. You are required to prepare the necessary account for recording the above transactions up to 31st December 2009, assuming 1. The asset account is maintained at net book value. 2. The asset account is maintained at cost. Solution 2.3. 1. When the asset account is maintained at net book value, cutting machines account, bank/cash. 1/1/2007 A/C 100,000, total 100,000. 1/1/2008 balance B/D 66,870, total 66,870. 1/1/2009 balance B/D 44,710. Depreciation: 31/12/2007 A/C 33,130 naira. 31/12/2007 balance C/D 66,000 naira 870, total 100,000. 31/12/2008 depreciation A/C 22,150. 31/12/2008 balance C/D 44,720, 66,870. Machine: 1/1/2009 disposal A/C 44,710. Depreciation account: cutting machines 31/12/2007 A/C 33,130. 31/12/2008 cutting machine 20,150. Profit and loss: 31/12/2007 A/C 33,130. Profit and loss: 31/12/2008 A/C 22,150. Machine disposal account: 1/1/2009 cutting machine A/C 44,720. 31/12/2009 profit and loss account 17,280, total 62,000 naira. 1/1/2009, cash/bank account 62,000 naira, total 62,000 naira. 2. When the asset account is maintained at cost cutting machines account. 1/1/2007, bank/cash account 100,000. 1/1/2008, balance B/D 100,000. 1/1/2009, balance B/D 100,000. 31/12/2007, balance C/D 100,000 naira. 31/12/2008, balance C/D 100,000 naira. Machine disposal 1/1/2009, A/C 100,000 naira. Provision for depreciation account 31/12/2007, balance C/D 33,130. 31/12/2008, balance C/D 55,280. Equal 55,280. 1/1/2009, machine disposal A/C 55,280. 31/12/2007, profit and loss account 33,130. 1/1/2008, balance B/D 33,130. 31/12/2008, profit and loss account 22,150. Total 55,280. Balance before depreciation 1/1/2009, 55,280. Machine disposal account 1/1/2009, cutting machines account 100,000. 31/12/2009, profit and loss account 17,280, totaling 117,280 naira. Provision for depreciation 1/1/2009, account 55,280. 1/1/2009, cash/bank account 62,000, totaling 117,280. K. Fixed asset management. This is the procedure established in an organization to properly account for its fixed assets. This will involve maintenance of adequate records, e.g. asset register, ensure security of the asset, e.g. by providing insurance cover and carry out regular repairs and maintain when due. A fixed asset register is a memorandum book used for recording detailed information on fixed assets. Information in the asset register include date of acquisition, reference number, cost of the asset, depreciation charge, net book value, etc. The relevant information for ensuring appropriate management, recording and disclosure of fixed assets are detailed out in the Statement of Accounting Standard as follows. SAS 3, Accounting for Property, Plant and Equipment. SAS 9, Accounting for Depreciation. SAS 13, Accounting for Investment. Summary. The account current consists of the entries to record acquisition capital expenditure incurred, depreciation and disposal of assets. Capital expenditures are recorded as part of the asset, while revenue expenditures are recorded in expense account. Intangible assets are long-term assets that lack physical substance and include patent, research and development costs, franchises, trademarks, and costs. The most common methods of calculating depreciation are straight-line method, diminishing balance method, and sum of the digit method. Accounting depreciation and disposal of assets depends on whether the asset account is maintained at net book value or whether the asset account is maintained at cost. This is the end of study section 2. Thanks for listening.